Hello and welcome to this week's episode for SPY Trader Now. I am your host. My name is Ken, and our model portfolio is up 6.42% year to date as of June 3rd, 2023. And we have made a total of 17 round-trip trades. And the S&P buy and hold investor, they are up 11.75%. So we are trailing behind the S&P 500 buy and hold investor by about 5.5% year to date. And that is not our goal here. Our goal is to beat the returns of the buy and hold investor. So we have our work cut out for us. Obviously, I have been trading the portfolio too conservatively compared to the market, but the risks are elevated, and that is the reason for my conservative trading pattern so far year to date. Right now, the portfolio is 100% in cash, and we do a simple three-position portfolio here where we either do shares of the S&P 500 with the ETF symbol SPY, or we do options in SPY, or we have the portfolio in cash. Currently, we're in cash. Here are some past returns of how we have done. And in 2022, the model portfolio was up 21% compared to the S&P 500, which was down 19%. And in 2021, we were up 78% compared to a 28% return for the S&P. And in 2020, we actually doubled the portfolio, 100% return. If you want to see how I do this, go ahead and hit that subscribe button, ring that bell, and smash that like button down to be notified when I post a new video. Thank you. Here at SPY Trader Now, we buy, sell, and trade the S&P 500. This is a one-year chart for the S&P 500, and I'm going to go through the charts in much greater detail later on in the presentation, but I wanted to show you the trade that I made on 5/30/2023, sell to open, 2 cash secured puts with a 415 strike, expiration 6/2, which was Friday yesterday. And because the market just jumped up on Friday, our strike price at 415 was never exercised, so we never got executed in owning those shares. For last week, the S&P 500 gained 1.8%. And the reason why it did it basically happened all on Friday was because on Friday, the May jobs report shocks economists, where the information showed that there were 339,000 jobs created in May, topping Wall Street's estimates for 195,000. Obviously, the market loved it. And you can see the jump right there that the market made, overcoming this resistance line here at approximately the 420 and just jumping up to it. And now we're at 427.92. Here's that trade that I told you that I sent out on 5/30 at 10:52 a.m. Pacific Standard Time. If you would like to receive my trade alerts via email and text message, you can sign up at spytradernow.com. There'll be a link down below for you to do so. Here are all the trades I've made for calendar year 2023. If you want to see all my trades going back for the past 3 years, you can head over to SPY Trader Now to do more research on that. Here is my equity curve of the model portfolio for 2023 year to date. Here is the equity curve for the S&P 500 buy and hold investor for 2023. And here are the two equity curves combined on a percentage basis. So this way you can see how well they are doing against one another. This is the Fed Chair, Jerome Powell, and the last interest rate hike was done on May 3rd, 2023, 25 basis points, bringing your federal funds rate to this level right here. The next federal FOMC meeting announcement will be on June 14th. The question is will we have a 25-point rate hike, or will the Fed pause at this time? Now we're looking at things from a presidential election cycle theory. And what it states is that depending upon what year you are in, according to the election, will give you some historical returns. Currently, we are in the third year of President Biden's term. And in the third year of the presidential cycle, the market has gained on average 16.3%. Right now, the S&P 500 is up 11.75%. So there's room for this portfolio, for the S&P 500 to grow, still remaining in this year. Now we're looking at things from a bond market outlook. The bond market is telling us to get out of the stock market. And we want to listen to the bond market because the bond market is 4 times the size of the stock market. We still have an inverted yield curve, meaning that the longer term treasury rates are at a lower yield than the shorter term 3-month and 2-year yields. So this is an inverted yield curve. Also, we have rising interest rates. So this is not good news for stock market investors. But as you can tell from what the stock market has been doing lately, as of right now, that does not matter. But we just want to take this information and understand where we're at in the business cycle. Now we're looking at things from a valuation standpoint according to current market valuation. Their link is here and it will be down below in the description. Currently, the S&P 500 is overvalued by 44.8% above the modern era market average of 20 PE. We're currently at 29.2, and on a standard deviation chart, that puts us at right around the 1.1. This is the Fear and Greed Index. This is our friend Warren Buffett, and currently we're at 65, and last week we were at 66. So we're not at extreme greed yet. So it's okay to deploy long-term capital into the S&P 500 knowing this information. Now we're looking at it from a seasonality outlook. This here is going back 20 years for the S&P 500. And there's your 20-year mark right there. We're currently in the month of June. The month of June is the second worst month of the year for stock market investing. And it's a huge drop-off compared to May. Now, for the month of June, there's a 60% probability that we're going to close higher than when we opened. Currently, for the month of June, and there's only been just a few days of trading for the month of June, the market is up 2.41% for the month of June. So right now, we've already accomplished that goal. But considering that this is the second worst time of the year for stock market investing, I see more downside happening within this month than upside for right now. Now we're looking at this from a long-term 20-year horizon monthly chart, S&P 500, long-term bull run since 2009. Then we came down in this trading channel. We broke out above it and we are bullish as long as we stay above this now support line, and we are clearly above it. Right now, it looks like this is going straight up to the moon. The MACD did it cross its signal line? It has not crossed above its signal line yet, but boy, it's getting close. Slow stochastics is nicely traveling north. These are strong indications that we're going to continue from a long-term outlook. We're going to have bull market expectations. Now we're on a weekly chart going back 5 years, S&P 500, and you can see that we just broke above this new trading range right now. The MACD and slow stochastics all positive. Now we're looking at a daily chart, 1 year, S&P 500, and you can see here where we broke out in this chart as well and how the MACD and slow stochastics look. Now we're looking at the same chart, but instead of looking at 1 year's worth of data, it's only going back 6 months worth of data. Now on this chart, I threw in something new. It's called the Fibonacci retracement, and I captured it from this closing bar right here to this peak that we just experienced on Friday. And the 50% Fibonacci retracement is at 416.57. So it's approximately at the 417 mark, okay? So I'm expecting a 50% retracement of this move to take us somewhere around this neighborhood. That's why I threw in this Fibonacci retracement level. Now we're looking at a ratio chart of the RSP, which is the equal weighted S&P 500 compared to the standard weighting S&P 500. And I also threw in there the S&P 500, which is in this dark blue line, and I also threw in the RSP line, which is this lime green. Now, from 2009 up here to 2020, you know we had a good long bull run. And you can see that generally speaking, when you have a good long bull run, the equal weighted S&P 500 outperforms by a slight margin the normally weighted S&P 500. So that's under a normal bull market configuration. Here we are right now today. You can see them kind of joined together where they came down and met. But here is the part that I want to bring out. On the ratio chart, which is the black and red line, you can see how we fell off a cliff recently. This has happened 2 times in the last 20 years. Now, the other 2 times that this has happened, the S&P 500 has had a decent correction, falling off a cliff as well, here to here, and in 2008 from here to here. But in 2023, the ratio has fallen off a cliff, but the S&P 500 has not fallen off a cliff. So if it does not fall off a cliff, then that would be really something. But we need it to see it continue to go up. If this thing starts to curl down, we do not want to be long the S&P 500 because we don't want to be caught in this downturn. But right now, all indicators indicate that the S&P 500 is moving north and not moving south. And if we want to participate, we got to be long some cash in this market. Here is the VIX, or the volatility index, and look at what happened on Friday. We broke below range on Friday. The fear is really dropping out of this market. Now we are looking at the Think or Swim TD Ameritrade's trading platform, their chart platform, I should say. And here you can see standard deviations, +2, +1, -1, -2. We just broke above the +1 standard deviation. We haven't spent that much time above the +1. We have to go back into August of 2022 and then back into July of 2022 to see some really long trading time in this pattern. So it was unclear whether we were going to bounce up and come down or what's going to happen, but the market is just showing an unrelentless bullishness so far. Now we're looking at the same chart, but instead of going back 1 year, we're only going back 3 months. So here we have not even crossed above the +1 standard deviation, but in the last 3 months, we never, except for over here, just crossed above it for basically 1 day and then came down. So we need to see, and here we haven't even met the +1 yet. So this market can certainly go slightly higher to higher. I just gave you a ton of information in this presentation. Now comes the critical thinking. What are we going to do with that information? Well, my market summation according to SPY Trader Now as of June 3rd, 2023 is that the market is showing it just broke above a trading range, but it is not confirmed if it will stay there. The only way it can confirm that is if it spends more time above that trading range. Cash secured put trading has little profit. So my plan is to place an in-the-money covered call with a 417 strike, which is approximately 3% below its current trading price. I'm going to use a June 16th expiration, which is an 11-day trade, which is going out 2 weeks rather than 1 week. And I'm going to get paid a premium of $12.49 as long as the market on Monday opens up the way the current option price is showing right now. And this is about this is only about a 12.5% return on investment. I plug that into my cash secured put calculator. By the way, if you do want this calculator for free, you can head over to SPY Trader now. There'll be a link in the description below, and there'll be a spot for you to download this calculator if you would like to use it as well for your trading. Now, this is an 11-day trade. Annualized, it's going to pay out 12.54%. That's if I allow my shares to get taken away from me, and that's if on the expiration date, the market closes above my strike price of $417. Obviously, if my shares close below the strike price, I'm going to not be exercised and I'll be still holding those shares. So that only time will tell where the market's going to close on the expiration date of June 16th. But I don't think it'll close below that, but you never know. But hypothetically, if it starts to creep down and get towards my 417, what I'm going to do is that option value, which is currently at $12.49. And by the way, I should mention that the intrinsic value is $10.92. So that's the in the money intrinsic value. If the option price begins to drop from $12.49, and if the S&P 500 goes down and I see that intrinsic value get close to $1 or somewhere in that neighborhood, and I'm not going to hold this option any longer. What I'm going to do is I'm going to buy to close it, pocketing that cash and then keeping the 200 shares. So that's I'm going to be watching the market to see how the market plays out. On a worst case scenario, well, no, not the worst case scenario, because the worst case scenario is that the market would drop to some really low level, like 10 or 20% within the next 2 weeks, and meanwhile I'm holding 200 shares and I'm experiencing that drop. That would be the worst thing that could happen. But another thing that could happen is that instead of the market going down, the market's going to go up for the next 2 weeks. And if that's true, I'm going to get called out. My shares will get called away from me, and I'm just going to get a return on investment of only 12.5% on an annualized basis. So that's not much money to be made. So I'll make some money, but I'm not going to make a boatload of money if the market keeps going north. But I'm telling you how I am going to play it. This is how my expectation to play the market for the next couple of weeks. So that's where I stand. What do you think of that? You can leave your comments down below if you think I'm on track, off base, or whatever. I'd love to know how you're playing the market. So if you can, go ahead and leave some comments down below. So that's it, and I wish you good trading.